All right, get this. Treasury Secretary Janet Yellen recently said that uninsured deposits might still be at risk in future bank failures. So, what does this mean for your and my money? How can we remain protected? We're going to be covering that, as well as how FDIC coverage actually works in today's video. So make sure you stick around. You're not going to want to miss this. In recent days, account holders at the failing Silicon Valley Bank and Signature Bank received a huge break, as emergency federal efforts actually made sure that millions in uninsured accounts were saved. Yet, according to Treasury Secretary Janet Yellen last week, it might not be the same if a different bank fails in the future. And I want to take a closer look at why. Well, the Federal Deposit Insurance Corporation, or FDIC as we know it, provides depositors with coverage of up to $250,000 per bank and per account ownership category. At the time of its failure, SVB had uninsured deposits from many of its clients who were primarily venture capital firms, small technology companies, and business owners. And according to statistics from 2022 from S&P Global Market Intelligence, 94% of SVB's depositors had balances of greater than $250,000, which is the FDIC cap. Bank regulators announced a plan to fully insure all deposits, among other measures that were aimed at assisting in preventing the emergence of greater financial emergencies. President Biden recently stated that both American citizens and companies can actually trust that their bank deposits will be available when they're needed. But according to Yellen, in the future, uninsured deposits will be only protected if failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences. These recent events, they might remind you of the 2008 financial crisis. And while experts are saying that this time is different, there's no guarantee. And another failure is certainly possible here. So, needless to say, now is definitely the time to ensure that your deposits are secure. That said, let's go ahead and dig into how FDIC coverage works. So FDIC coverage, which has been provided since 1934, hasn't caused any depositor to lose insured funds. The agency is funded by premiums, and they're paid by the banks and savings associations, and most Americans are covered as they have less than $250,000 in their bank accounts. The insured premium is determined by the legal owner's name. For instance, a married couple that's running a business, they may have up to $250,000 that's insured in a business account, up to $250,000 insured in a personal account belonging to one spouse, and up to $250,000 insured in a personal account belonging to the other spouse. So examine your bank statements very closely to see if your deposits are in fact FDIC insured. Asking whether your money will be FDIC insured should be your first step whenever you actually enter into your bank or a new bank, whenever you're depositing money anywhere, to see whether your money is covered at your institution and then whether any percentage exceeds the coverage limits. You can also check the FDIC's electronic deposit insurance estimator. Opening accounts at multiple banks, especially if you have more than $250,000 in deposits, is a great option to increase your coverage. You can also ask to speak with your current bank if you want more coverage, and they may occasionally collaborate with other FDIC insured institutions to safeguard and insure larger cash deposits. Also, small businesses might want to investigate the prospect of getting extra coverage from multiple institutions too. If your bank fails, the FDIC will reimburse you in full, together with any interest accrued up to the date of the default. Not all accounts offer FDIC protection. For instance, the Securities Investor Protection Corporation, or the SIPC, they're likely to provide protection for a brokerage account that's been opened with a financial advisor. If your brokerage firm experiences a disaster, SIPC will cover you up to $500,000 with a cash limit of $250,000. Now, unfortunately, SIPC protection is restricted, and most significantly, it does not offer protection if the value of your assets drop. Have you done anything differently with your money following all that's happened in recent weeks with SVB and Signature Bank? Please let us know in the comments below. Certainly want to hear your story and make sure that we understand exactly how we're all managing to balance this and protect ourselves moving forward. Don't forget to like and subscribe to today's video. Share it with anybody that you think this would be beneficial for. And until we see you on the next one, make it a great day today and keep on cash flowing. Take care.